Hello, I'm Clay Moffat, and welcome to Moffat on Money. Today, I'll be addressing the topic or the subject, the most recent event of the BOE, the Bank of England, BOE, uh, their action this week to save the Gilts. Actually, it was an action to save banks and pension plans from destruction, or otherwise known as stupid should hurt. My rule number two. This is a little bit more of a technical presentation than what I usually do. If you've watched my previous videos, it'll aid your understanding. But this is a track I'll be offering in addition to the regular videos for those with more of a finance background who want a little bit more of a technical discussion. After I finish, if something doesn't make sense or you have any questions, then uh, specific questions, then let me know and I'll try to answer them. Now, over the past month, I've talked about how the Fed will keep hiking interest rates and that inflation isn't going away anytime soon. Um, and they will keep doing it until something breaks. Well, the other day, something broke. People have talked about how rates are too high, how they can't afford a mortgage, and these kind of things. And I got to admit, I kind of have laughed a little bit silently because rates are going back to their historical normal rates, their normal averages. They've been kept so low by the Federal Reserve for so long that people have adapted to them and think that's normal. But these low rates have distorted the markets. They've distorted risk and return, that relationship that should always exist between risk and return in an efficient market. And the problem really is that, it's not that rates are high, it's that they've been too low for too long. The market, including pension fund managers, actually started adapting and started thinking that those rates were reality, were a new reality, and adjusted their management strategies accordingly. Well, that's a very real, very dangerous problem that we face today, one on par with the subprime crisis in 2008. But very few understand that. Few. But if you watch over the next 10, 15 minutes, you'll have a much better understanding of what's going on in the marketplace. Now, I believe it was Wednesday, the BOE capitulated, or what people think is capitulated, in the face of the Gilt collapse. Gilts are the United Kingdom government bonds, like our treasuries, their equivalent of our treasuries. The Gilts, the rates on the Gilts soared by about 150 basis points just in the past week alone. Now, that may not strike you as much, but normally an increase of 2 or 3 basis points a week is a huge event. So that should give you a little perspective. The Bank of England, after ignoring calls for several days to intervene in the market, because remember, central banks have been trying to draw liquidity out of the market. They've been raising rates and they quit quantitative easing. They quit supplying money at extremely low interest rates, or free money, to the market. And in fact, they've been trying to withdraw some of that excess money that they've supplied to the marketplace, that excess money that's created the high inflation that we're all experiencing, in order to bring some stability to the market. Well, so they're raising rates, they're withdrawing liquidity from the market. The rise in the yield in the gilts has been literally catastrophic in terms of its implication for the United Kingdom in terms of government borrowing, as well as for a lot of their fund managers, including pension fund managers. Um, so the BOE decided to move into the gilt market to stabilize it by buying gilt denominated bonds and not only halting the quantitative tightening, QT, but by pivoting to QE, back to QE, quantitative easing, supplying free money in one fell swoop. So the BOE announced they would purchase a unlimited amount of gilts on the long end of the market to restore some semblance of orderly markets. It also announced it was going to delay the sale of nearly 800 billion in gilts that it had purchased over the past few years, doing QE. And it's really tantamount to an admission by the BOE that they have lost control of the monetary market in the United Kingdom. It's following the market rather than leading. That's not an enviable or good position for a central bank to be in. It's a transition of hugely significant importance, of enormous impact. So that's the headlines, and most are wondering, how does this affect me? I really don't care if currency traders get slapped around. Um, well, if you have money in a bank or if you have a pension plan, then this affects you or could greatly affect you. How so? First, you have to remember that UK bond prices, their sovereign bonds, the gilt, were the prices were collapsing. Remember the teeter totter we talked about, a, a month ago? Well, as the prices fall, yields rise. So we saw the rise in yields, the prices were collapsing. This event was actually, people look at this and go, big deal. This event was actually because pension funds were having to dump, and by dump, I mean fire sale, long debt in order to meet margin calls. Margin calls, you say. Well, understand this, that yields on long debt for a decade or more have been at historic lows. And a pension fund has to have a certain yield in order to meet its obligations to pay retirees what the retirees want to receive. So the pension bonds will oftentimes buy or own government debt. It's safe, it's secure, um, and it's a common investment, particularly for those funds who try to meet their future liabilities. The, the their liabilities are the payments owed retirees. Now, this is an investment management technique called liability driven investing, LDI. LDI simply means that the fund manager knows he has a future liability. There's an individual or a group of individuals that are going to retire in 10 years. And he knows that he's going to owe them $1 million in 10 years. So, in order to reduce his risk and ensure that he can meet his liability, his obligations, he sets aside a portion of his portfolio, dedicates a share, a slice of his entire portfolio to that future liability, to paying that future liability off. Here's where the low returns are killing the pension funds, which actually increases the risk for the retiree, you. At a 2% yield, remember, with the low interest rates over the past decade, at a 10-year bond was about 2%, 1.75, 2%. At 2% yield, the manager has to set aside almost $820,000 to meet that $1 million liability in 10 years. $820,000. That's a pretty big chunk of money. Historically, with the higher yields, normally in the range of 5 or 6%, he would have to set aside 550, 575,000 instead of the 820. So a huge difference in capital being set aside. Now, normally if yields drop, you would expect the sponsor of the retirement plan, the employer, whoever who set up the plan, to have to contribute more. But they haven't. Whether it's state, local, city, county, private corporations, they haven't been setting aside additional money. So that increases the pressure on the fund manager to try to increase his yield, look for ways to increase the yield so that he can, meet his future obligation. By increasing the yield, This implies additional risk which is uncommon for pension plans to take on. Now, one way in which these pension fund managers have engaged in to try to increase their yields is entering into something called an interest rate swap. They're trying to actually hedge their liabilities due to the low rates using these swaps. So, what's a swap? Well, uh, if you look at this schematic, this shows what a simple swap looks like. You've got an investor, or it could be another institution who owns a fixed rate bond and is receiving fixed rate interest. You own a gilt or a treasury 10-year bond paying you 2%, and you receive that 2% interest every year. Well, your risk is that interest rates rise, but the yield on this fixed rate doesn't go up. And obviously, remember the teeter totter, that price of that fixed rate bond goes down. So you try to hedge against that risk. You do a swap with somebody else, here the dealer. You pay them the fixed rate you receive. Fixed rate bond pays you, you pay that to the dealer. In return, the dealer pays you a floating rate, here identified as LIBOR, which is a very common floating rate. Probably be LIBOR plus a spread, but right now we'll just go with LIBOR. So as the interest rates rise, LIBOR increases. Your fixed rate doesn't. So what you've done is convert this bond actually to a floating rate bond for the life of the swap, which may be 5 years, maybe 10 years, maybe longer. So you're receiving this adjustable rate. Well, as interest rates goes up, everything, seems to be in pretty good shape. You're happy with that. But unfortunately, that's not the whole story, because in order to enter in that swap, you have to post collateral, and bonds are posted that are denominated in the same currency as the swap. So in this case, if you're a UK pension fund and you're swapping out the yield on a gilt for LIBOR, which stands for London Interbank Offered Rate. It's an international adjustable rate. But if you're swapping out for that floating rate, then you post gilts as collateral. So by swapping the floating rate for the fixed, they did increase their yield over the past year. Well, this was done expecting inflation and rates to remain somewhat lower. Everybody was thinking inflation was transitory and it wouldn't be long, wouldn't be a huge jump. Well, what we're experiencing is very high inflation, and central banks have jacked up the interest rates. Well, it's causing the floating leg swaps, the rate that adjusts, to increase, but it also has acted to slash the value of the bonds being held as collateral. Remember the teeter totter? So you've got this thing happening. Remember, when I talk about interest rates increase, this is the swap rate, overnight index swap rate, a very common rate. You can tell how it has just absolutely jumped. Well, that increase in rates has led to lowering of the value of bonds. Well, how low, you say? Well, here you go. This is the loss in terms of percentages of the bonds, 30-year bond, the longer bonds. An example of the collateral that was posted for these type swaps. As the collateral value has dropped, the pension funds get margin calls. Now, to raise additional cash, they can either take out of their current cash accounts or, sell some of their liquid assets. Only problem is that, or pledge some of their liquid assets as additional collateral. Well, the assets that they have uh, on the liquid component of their balance sheet are riskier assets than the swap clearinghouse, think of a broker, will accept as collateral. So the pension fund has to go to a bank to raise the necessary liquidity. They have to borrow cash from a bank in order to provide additional collateral. Now, banks understand or understood what they were doing. And as the rates went higher, the risk of insolvency gets higher, that the pension fund will have increasing difficulty meeting its obligations. Think of Detroit when it declared bankruptcy because its pension couldn't pay out its liabilities. So the banks were also hedging their risk against their borrower, the pension plan, defaulting. So bankers took out OTM, out of the money payer swaptions. This is just the other side of the swap. They're paying fixed and receiving floating, so that they benefit as the rates rise. This ended up exacerbating the problem and increased the pressure on the margin calls experienced by the pension plans. In addition, these pension plans were big players in what we call the repo market, the gilt repo market. They would lend out collateral to leverage funds to use on short-term basis. But now this supply is drying up. They're having to withdraw these gilts to sell or repo out cash in order to fund their margin calls. So the market, with all this supply being dumped on the market, isn't able to absorb it. And as such, the result in the crash in price that we showed over here on this slide. Now, when a bond or an institution could be, because there are some banks in this position as well, when a bond or institution sells assets, the asset prices are determined by supply and demand. And there's a normal supply and normal demand, so prices are relatively stable in the bond market. Well, as increased supply is being dumped in the market by these pension funds having these margin calls, the market can't absorb it, so the price really starts dropping. Well, the pension plan thought it might get 95 cents on a dollar or pound, and by the time they sell it, it's dropped to 90. So what do they have to do? They didn't receive enough cash, so they have to sell even more. Well, this increased supply in a market that can't absorb the previous level of supply causes the price to drop even further. So they receive even less. So they have to sell more, which forces the price down. They receive even less. Do you see what's going on? It's called contagion, or the Lehman effect. It's what happened in the subprime crisis in October when Lehman declared bankruptcy. Now, that's, this being a Lehman moment or very close to it is why the BOE did such a quick pivot and went from QT to QE. Now, what's important for you to understand, even if you're not British, that UK pensions were the first to experience this problem. But most other pension plans, including those that use LDI management techniques, are in the same boat. There are also several banks that are in the same boat that have the same payer swaps or swaptions. There are a lot of rumors out there on Credit Suisse. People are referring to it as Credit Suisse. And Deutsche, for example, both have huge exposure. And if you look at their prices, they are tanking quickly, even more than during the subprime crisis, which is saying something. If you want to look at the spreads on Credit Suisse's swaptions, you can tell they are here almost as high as they were during the subprime crisis. So that gives you some idea of the market, the informed market's view of Credit Suisse and their current risk. And that's saying something. So does this signal a pivot, a global pivot back to QE? Does it mean that The BOE, the Fed are going to start going full bore QE. Obviously, it's opened a bunch of eyes in the central banking community, a hitch they really didn't expect or predict. And this does change things. The global economic landscape changed this week. The Fed is paying attention to the market. The huge drawdowns experienced in bonds, the soaring swap rates, these things result in impossible collateral demands. Pension funds and banks are stressed, financially, economically stressed. Volatility is extremely high. The move, which is a volatility index on bond options, so it's kind of representative of the risk in the bond market, is higher than during COVID. On the other hand, the central banks also know that inflation is still problematic. This last month, the core PCE rose. This is a key inflation index that the Fed follows. Um, so the rate increases so far haven't had the effect on inflation that the Fed wants, hoped for, or maybe even expected. And they've been relatively unified. They've been unified in talking about future rate increases, even maybe talking about hiking rate increases up to 100 basis points instead of 75. Can they stick to it? What happens to the Fed, the perception of the Fed being in control if they don't, if they do a quick pivot? Do they go back to repeating the same mistakes that got us where we are today by re-engaging in QE? Personally, I don't expect the Fed to engage in an immediate pivot. The Fed actually has a huge, massive repo program going on the past month. Repos just hit an all-time high this week of 2.49 trillion dollars. That's massive. The Fed is providing some serious liquidity in the short end of the market as liquidity in the long-term market dries up. So will it be enough to prevent another Lehman moment? I don't know. Can't say for absolute certain. But the Fed has, we need to acknowledge the Fed has two conflicting problems. First of all, volatility in the bond market, which we talked about last week, and inflation. Okay. The board has been united, as I mentioned, on raising rates, put on a unified face, so to speak. But Thursday, Friday, some cracks started showing in their armor. Some of the governors, are kind of modestly expressing concerns about systemic risk since the BOE action. They likely will choose somewhat of a middle course, accept higher inflation and lower rate hikes while not pivoting to QE again. Um, how they'll mix that? Do they do a lower rate hike but continue with QT? Do they pause QT? Can't really say the exact formula they're going to take. One other possible option would be to allow the distressed banks or bank partners, the pension funds, to access the discount window. Now, the Fed did this during the subprime crisis. Basically, the partners bring the collateral, the risky collateral that banks don't want to accept or brokers don't want to accept, to the Fed, and the Fed provides liquidity. It's kind of QE on the down low, but only to specialized institutions and for specific events, such as, the margin calls for pension fund. So I could see that happening, but that's only a guess. We'll simply have to watch with, keen interest over the next few weeks to know better. Some of the inflation numbers coming out will be of huge significance too. What does this mean for investors? From my perspective, the market is still too risky to invest in. Cash is king. Um, and I'll remain on the sidelines. Trading right now is just begging for losses. Remember, most successful investors avoid the big drawdowns. And we're not done yet. This market is not reached a bottom, my humble opinion. We'll see. what happens. Expect some, again, dead cat bounces, but there's some serious problems out in the economy, both the US economy, the global economy, and looking at market valuations, they're still too high. So, hang on for a ride, keep your powder dry. And I think you'll be, far better off in the long run. We'll go further into this inflationary recession and the market in future sessions. If you will, hit the like and subscribe buttons, turn on notifications, do all those little, YouTube and Twitter things, and I'll continue to do my best to try to communicate to you finance things in an hopefully understandable and coherent manner. Um, Looking for any ideas of interest from you for future discussion, feel free to comment below or DM me at Twitter, Moffat on Money. My time is up. I thank you for yours.